Now, to start with, an SMS is a reversal pattern just like a chock or a flip. The main focus for the SMS is that there is a reversal of price. Regardless of how the candle formation is, we just want to see price reversing. That's all we are worrying about. So, why have I decided to combine chocks and flips into a SMS? Now, quite simply, if we were fixated on a specific entry model, like a chock, we are going to be mostly looking for that impulsive push to break past the recent low like we have here and looking to grab an entry. Now, quite often what happens with quite a lot of traders in this fact actually is when they're looking specifically for this, they're actually missing what's going on over here. Now, if we don't get that change of character happen here, they might then be missing something like this happening over here. So what is the difference between a chock and a flip? So first off, we can see we have a high being formed. We then have higher low, a higher high, which has caused this breaker structure. Now this higher high has then impulsively pushed below the most recent low. This is where the character of the market is essentially changed from being bullish to now shifting to bearish. And at that point, we can start looking for shorts. Now this is more probable if we have a sweep of significant liquidity, like a session liquidity to the left, and or a mitigation of a higher time frame POI. And this will work the same way with a flip. We have a high being formed just here, a higher low, a higher high, which has caused a break of structure. But unlike the change of character, this higher high has not broken past the most recent low, but instead what we've done is created a higher low, and then a lower high, then a new low, then a lower high, and then the low that has created the higher high has then failed. So in the build up to this, it's possible, not always, but it is possible to start seeing newly formed order blocks in the build up to this low being taken. So we might see some order blocks, we might see some sweeps where maybe one of these highs might sweep beyond a previous high, but failing to break past the higher high. But ultimately, the direction of the market is slowly turning bearish. Okay, now a chock is a bit more aggressive, it happens quite quickly. A flip does take a little while for it to play out. But as you can see, in both instances, they both are price reversals. And that's all we're really concerned about. So here's a very nice, simple overview of a basic shift in market structure that you can see has behaved quite similarly to a change of character. First off, we have a bearish breaker structure, as you can see, nice impulsive breaker structure, a little bit of sideways movement, and then another impulsive breaker structure, a bit more sideways, impulsive breaker structure once again, slight pullback, impulsive break, and when this new lower low is being formed, we then have an impulsive push to the upside, creating our SMS, which if we look back to the previous slide, is very similar to our chock, just the other way around, ultimately leading to a further bullish breaker structure just here. So let's zoom out a little bit. How has this played out? Now, unlike the first example, we look back here where we have the recent low being broken and then the new low being formed and immediately come back up to our POI that has caused a change of character. What we can actually see here is we've actually seen price just mostly moving sideways without breaking any recent highs, and we've essentially come back down towards this imbalance, refilled the imbalance and mitigated this POI before a further impulsive push to the upside, ultimately changing the direction of the market. Now, it's very important to understand that we do not take a trade on an SMS just because it's an SMS. We need other confluences to be aligned with the SMS in order to take the trade. Now, those confluences can be things like higher time frame point of interest mitigations. So we could have a point of interest further to the left that is on the higher time frames that this has occurred inside of. We could also be looking for a session liquidity sweep. So we could have the Asia low or the London session if we're trading in New York, sweep in the previous session where we could then start looking for this as the liquidity grab, and the impulsive push is the move that has happened after the liquidity grab, and quite similarly with daily, weekly, monthly highs and lows. If you're familiar with the LSM strategy, you'll know that is a frequent thing that is looked for within that strategy, that we look for highs and lows that belong to a monthly, weekly, or even daily piece of structure. And once that high or low is taken, we often get an aggressive pullback. Now in this example, this is a little bit more like a flip example. So what we can see here, bearish breaker structure, and then a further bearish breaker structure, and we've got a nice impulsive leg pushing to the downside. Okay, another bearish breaker structure just here, Now this is the last bit of structure that is essentially formed when we had created this low. So we have this break of structure, which is caused by this high has then created this low just here. So if we need to see a shift in market structure and price reversing, we need to see price breaking beyond this high. If we continue breaking past this low, then we essentially shift our focus to the most recent high that has broken that low. Now, if we zoom out in this instance, what we can see is this high doesn't get broken until the following day. Now, if we look at the timestamps at the bottom, this high was created roughly just before 6 o'clock in the evening on this day, as you can see at the bottom there. Now, if we look over to the right, by the time this SMS actually occurs, it's just over 12 hours later. It's not till roughly 7 o'clock the following morning that we actually see this shift in market structure, as price has mostly been stagnant and sideways throughout the Asia session overnight. So at this point, this is when that shift in market structure can be confirmed. Now, all of this price action, as you can see, is been geared or engineered from this high impact news event. So we've got a giant liquidity sweep here, a very impulsive push to the downside. Then the markets have then slowly started to calm down. If we zoom out even further, we can see that over a period of time, over a couple more days, we can then see it's taken its time to get back up to roughly where it started from and start aiming to correct this price action. So as you can see, a flip does take a little bit longer for it to actually present itself. However, the outcome is still exactly the same. We're still looking at a reversal. And in the next video, we will discuss in more detail how we can use this to our advantage and actually enter a trade setup. So if you have any questions in the meantime, please feel free to reach out. Other than that, see you in the next video.